You know, I've noticed something fascinating about human nature over my many years studying markets. We all crave complexity. We think that if a strategy is complicated, it must be smarter. We pay hedge funds millions for sophisticated algorithms. We dive deep into technical charts with countless indicators. We seek out the newest, most complex financial derivatives. But my friends, I'm here to tell you a secret that took me decades to fully appreciate. The most powerful investment strategies are almost embarrassingly simple. They don't require a PhD in mathematics or a supercomputer. They require something much rarer: emotional discipline and a steadfast commitment to a few timeless principles. Let's talk about the most important of these principles, the one that has protected me through market crashes, inflationary periods, and economic uncertainty more than any other single idea. I call it the margin of safety, but you can think of it as your personal financial insurance policy. It's the simple practice of never paying full price for a business. Always insist on a discount. Now I know what you're thinking. Ben, everyone wants a discount, but this is different. This isn't about waiting for a 10% off sale. This is about demanding such a significant discount that even if your analysis is wrong, or if the economy turns against you, or if some unexpected bad news hits, you still have a built-in buffer that protects your initial capital. Let me make this brutally practical. Imagine you're buying a house. You've done your research, you've had it inspected, you've compared it to similar properties in the neighborhood, and you determine it's fairly worth $300,000. The emotional, impulsive buyer, the speculator, might offer $290,000 and feel clever about saving $10,000. The intelligent investor, the true business person, approaches this entirely differently. They recognize that their $300,000 estimate is just that, an estimate. The inspection might have missed something. The neighborhood could be changing. Interest rates might rise, affecting property values. So they make an offer of $210,000. Yes, you read that correctly. $210,000 for a $300,000 house. They're not being unreasonable. They're building in their margin of safety. They understand that the world is uncertain and their knowledge is imperfect. That $90,000 difference is their protection against the unknown. Now, will most sellers accept such an offer? Of course not. And that's exactly the point. The intelligent investor is perfectly willing to walk away from 99 out of 100 opportunities. They're not in a hurry. They understand that their greatest advantage is patience, the ability to wait for that one desperate seller, that one market panic, that one moment when Mr. Market is so terrified that he's willing to hand over a wonderful asset at a fire sale price. This is not just investing. This is a mindset. It's a way of operating in the world that prioritizes preservation of capital over spectacular gains, that values patience over activity, that embraces simplicity over complexity. And I can tell you from personal experience, that moment of panic is precisely when your careful preparation and emotional discipline pay for themselves many times over. Because while everyone else is selling in a blind fear, you're calmly looking at your pre-prepared list of wonderful businesses and asking the only question that matters: are they now selling at a price that gives me a massive margin of safety? Let me share with you a story from my own experience from from the dark days of 1974. The market was in a brutal bear market. The news was overwhelmingly negative. The general sentiment was that the world was falling apart. I remember walking into my office, and one of my junior analysts, a bright young man, was practically in tears looking at the stock tapes. "Mr. Graham," he said, "everything we own is down 40, 50, even 60%. It's a disaster." I sat down with him and asked a simple question. "Did you overpay for these businesses when we bought them?" He thought for a moment and said, "No, sir. We bought them all at significant discounts to our calculated intrinsic value. And have the fundamental earnings power of these businesses disappeared?" I asked. "Well, no," he admitted. "Most of them are still profitable. Some are even growing earnings." "Then," I told him, "the market is not presenting us with a disaster. It is presenting us with the opportunity of a lifetime. The same businesses we were happy to own at $50 are now being offered to us at $30. This is not a time for fear. This is a time for greedy calculation." And that's exactly what we did. We went through our portfolio, identified the companies that were now trading at absurdly low prices relative to their cash flows and asset values, and we bought more. We weren't guessing, we weren't hoping. We were acting with the cold, rational certainty of a mathematician solving a proven equation. The margin of safety we had built into our initial purchases is what allowed us to hold with confidence when others were panicking. And that same margin of safety is what gave us the courage to back up the truck and buy even more when prices became truly irrational. This is the ultimate beauty of this concept. It doesn't just protect you on the way in, it empowers you psychologically to take advantage of extreme opportunities when they inevitably arise. It turns market chaos from a threat into a weapon. Now, you might be sitting there thinking, "That's easy for you to say, Ben. You're a legendary investor. I'm just an ordinary person. I don't have the stomach for that kind of volatility." And to that I say, you are looking at it backwards. You don't need the stomach for volatility because the margin of safety is your emotional armor. It is the concrete foundation under your financial house that allows you to sleep soundly through any storm. When you know with mathematical certainty that you bought $1 worth of value for 50 cents, you don't worry about the market temporarily telling you it's worth 40 cents. You might even be hopeful that it goes to 30 cents so you can buy more. This shift in perspective is everything. The amateur is terrified of falling prices. The professional, armed with a true margin of safety, welcomes them. This is the ultimate edge. It is not a complex formula. It is a fundamental reframing of what price movements mean. They are not verdicts on your intelligence. They are merely opportunities to transact. Your job is not to predict the direction of these movements. Your job is to be prepared to act wisely when they inevitably swing to extremes. This is how you build wealth consistently over time, not by being the smartest person in the room, but by being the most disciplined, not by making the most trades, but by making the fewest, most calculated ones with the odds overwhelmingly stacked in your favor. The margin of safety is the tool that stacks those odds. But discipline without a clear method is just stubbornness. So let's get deeply practical about how you, sitting at home today, can actually calculate this margin of safety for any company you're considering. Forget the complex financial models for a moment. I want you to think like a business owner looking to buy a local bakery. What would you need to know? First, you'd look at the actual cash the bakery puts in your pocket each year after all expenses. Not the accounting profit, but the real cash. In corporate terms, this is often best represented by owner earnings or free cash flow. Then you'd ask, how durable is this cash flow? Is the bakery likely to keep generating this money year after year? This is the quality of the business, its moat. Now here's where most investors go wrong. They take that annual cash flow number and multiply it by some fancy multiple based on what other bakeries are selling for. That's following the herd. The intelligent investor does something radically different. They calculate what the bakery is worth to them as a private owner, based solely on the cash they expect to receive over time. This is your intrinsic value. Let's say the bakery generates $100,000 in annual free cash flow, and you believe it can do this for the next decade with moderate growth. You might calculate its intrinsic value at $1.2 million. The emotional buyer, seeing another bakery just sold for $1.1 million, might offer $1 million thinking they're getting a deal. You, the intelligent investor, would not even consider offering more than $800,000, and you'd ideally want to pay $600,000. That 25 to 50% discount is your margin of safety. It's your admission that your $1.2 million estimate might be too optimistic, that the bakery might face unexpected competition, that ingredient costs might rise, or that a new health trend might make your pastries less popular. This same exact thinking applies to buying shares of Microsoft, Apple, or any other public company. The principles don't change because the business is bigger or the shares are traded on a screen. The calculation becomes more complex, but the fundamental logic remains identical. Estimate the cash flows, determine what the entire business is worth to you as a long-term owner, and then insist on paying significantly less than that number. The size of your required margin of safety should vary based on one crucial factor: the certainty of your predictions. For a stable, predictable business like a utility company, you might accept a 20% margin. For a more volatile technology company, you might demand 40%, 50%, or even more. The greater the uncertainty, the larger the discount you require. This is why I generally preferred businesses that were simple, stable, and understandable. The easier it is to predict their future cash flows, the smaller the margin of safety you need, and the more frequently you'll find opportunities that meet your criteria. The goal is not to find the most complex, mysterious business that nobody understands. The goal is to find good, understandable businesses selling at great prices. This approach systematically prevents you from overpaying for story stocks or hyped-up concepts where the future is too uncertain to calculate any reasonable margin of safety. It keeps you grounded in reality, focused on businesses you actually understand, and disciplined about the price you pay. And that discipline, my friends, is what separates the lifetime investor from the short-term speculator. Now, I want to address the silent objection that's been building in your mind, the one about opportunity cost. But Ben, I hear you say, if I wait for these huge margins of safety, I'll miss so many other opportunities. What about all the great companies that never get that cheap? This is perhaps the most sophisticated and dangerous objection because it contains a grain of truth that makes it sound intelligent. So let me dismantle this piece by piece. First, recognize that this very thought is the siren song of speculation disguised as investment wisdom. It's what lures intelligent people into overpaying for mediocre businesses. The fear of missing out is perhaps the single most expensive emotion in all of investing. Let me be blunt. You will miss opportunities. You will watch stocks rise that you considered buying but didn't because they never reached your price. This is not failure. This is the system working as designed. The goal is not to participate in every rally. The goal is to build wealth over decades without suffering catastrophic losses. I'd rather miss 100 opportunities than suffer one permanent 50% loss of capital. But here's the beautiful paradox that most investors never discover until it's too late. By being ruthlessly selective, by passing on 95% of the opportunities the market offers you, you actually end up with far better results over time. Why? Because the few investments you do make will be so thoroughly researched, so deeply understood, and purchased at such attractive prices that their performance will dwarf the dozens of mediocre investments you could have made. Think of your investment capital as a limited number of bullets. The amateur sprays them at every target that moves, hitting some, missing many, and eventually running out of ammunition. The professional waits patiently for the perfect shot, the one where the target is large, stationary, and so close they can't possibly miss. They may only fire once a year, but that one shot brings home the dinner. This patience does something else magical for your psychology. It transforms investing from a stressful, constant activity into a peaceful, patient, waiting game. Instead of anxiously watching stock prices every day, wondering if you should buy or sell, you go about your life with a prepared mind and a shopping list of wonderful businesses with specific buy prices. When the market is roaring upward and everything is expensive, you feel no pressure to participate. You can actually enjoy the boom times knowing you're not overexposed. And when the inevitable crash comes, and it always comes, you don't feel fear, you feel anticipation. You're like a shopper walking into their favorite department store during a 70% off sale. This emotional freedom is worth more than any single stock pick. It's the difference between being a slave to market fluctuations and being the master of your own financial destiny. And this brings me to my final, most important point about the margin of safety. It's not just a financial calculation. It's a philosophical stance about your relationship with uncertainty. The world is fundamentally unpredictable. Black swan events happen. Industries get disrupted. Management teams make stupid decisions. Your own analysis will sometimes be wrong. The margin of safety is your humble acknowledgement of this reality. It's your way of saying, I know I don't know everything, so I'm going to build a buffer against my own ignorance. This intellectual humility is the mark of the true investor. The speculator thinks they can see the future. The investor knows they can't, so they build a fortress of price discipline that protects them regardless of what the future brings. In the end, the margin of safety is about more than just making money. It's about sleeping well at night. It's about protecting what you've worked so hard to accumulate. It's about being the calm, rational person in a room full of panicked or euphoric investors. And I can tell you from personal experience that peace of mind is worth far more than any extra percentage point of return you might chase by abandoning this discipline.